I want to start off with the surprise of the week, as always. And I think my surprise was Trump was claimed to be dead on the internet. I think that's quite funny that something like that can happen. He was offline for about a week, and then everybody assumed that he could be dead. He's already quite an old guy, so who knows? It could have happened, but he was alive and soon back on Truth Social and putting out those tweets, or what do you call it when you go on Truth Social, getting into beef with the Fed again. And I think that's because we continue to have some instability, and the Fed has two responsibilities. One is to keep inflation low, and the other is to make sure there is employment in the U.S. economy. And recently, there was an employment summary that released on Friday. This was released by the U.S. Bureau of Labor Statistics, and they talked about the job creations that happened in August and the unemployment rates in August. The total of jobs created in August was plus 22,000, which is a relatively small number, and it has shown little change since April. So this could signify that the total U.S. economy, the growth of the total U.S. economy, is slowing down. Job creation is, of course, very essential, very at the core of your economy. People need to work, they need to produce, and the unemployment rate has also changed a little. It hasn't gone up, it hasn't gone down. It's very, very stable, 4.3%. So there's no cause for concern. There's no major chaos, but you do see slowing down U.S. economy, and this is why Trump is actively pushing for the Fed to lower the interest rates, or this could be one of the reasons why he's pushing for lower interest rates. In the short term, this could improve the U.S. economy. It could the reason why it could increase or be beneficial to the U.S. economy is because with low interest rates, it's easier to invest or to gain access to cash that you can invest into your own business, and if you that investment leads ultimately to more jobs, which lead to growth in the U.S. economy. Now, given these statistics that both the new jobs have slowed down, the creation of new jobs has slowed down, and the unemployment rate is relatively stable, but it's not looking too. Those two together aren't looking too good. This might signify that the Fed is lowering their interest rates, but it is yet unclear what the tariffs will do and where the price changes for the tariffs will land. The tariffs, they will increase the price of everything, or they could increase the price. It's yet unclear where that price change will land, what the impact of that the price change will be. And I had some contact with a buddy of mine. He's a doctor in economics, and he said this is called tax incidence, and this explains who carries the burden of these tariffs. And let me draw this out for you. So we all know, or I assume most of us know, how price gets decided in the market. The P is for price, and the Q is for quantity. You have a line for demand, for and you have a line for supply. And where they meet, this is the price that the market is willing to pay for this. Is where they meet. That is the ideal price point. And tariffs are essentially a tax, and they will increase the cost of what is being produced. That's just a fact. But where these costs will land, that's yet unclear. But there's a way we can make this very visual. Let's say there's a tariff, and this increases the cost, so this pushes the entire supply line up, and it will look like this. There will be another intersect point. So given the supply, the price has increased. You see it has gone up. The demand, well, is made at a lower quantity. And now who will carry the burden of this increase in price? You can calculate that as follows, or you can draw it out like this. There are two different intersect points, the old intersection point and the new one. And they basically cross over. And if you follow the new line down from the old supply point, and let me use another color, this entire piece is paid by the supplier, and this entire piece is paid by the consumer. Now you can have a few different variations on this, because right now the elasticity of the demand, it's at like this, but the line can go straight down as well, and that means the entire price point is being paid for by by the consumer, which is not very good. It's yet unclear how this will play out. And there's another factor that's taken into account here. But before we move on, let me draw it out quite quickly. Let's say the demand line is like this. There is zero price elasticity. This was the old supply. Let me do D for demand, old supply line. Then this is the new, or this is the old price point. Now with the tariffs, the entire cost of everything goes up. So this is the new supply, and you have a new line. And if we draw our little tricky parts, now all of this is carried onto the consumer, and this could be a huge inflationary push. And with this inflationary push, the Fed could act and lower or decrease interest rates to boost the economy. No, I'm saying it wrong. The other way around. They want to combat inflation, so they might increase the interest rates. And another factor that plays into this is that most businesses that sell to consumers, they could see these tariffs coming. Trump had anticipated that the tariffs would come, and there was some pauses here and there where you could stock up on supply, and therefore there's still a lot of supply that has been bought at the old prices and can still be sold at the old prices. So it's yet unclear how this will carry over. Maybe the tariffs, the price impact for the consumer could be relatively low, but that's still unclear, and I think that's something that the Fed is still looking at. And it's not strange for them to wait this situation out. So I think that is the entire Fed part and the employment situation over in the US. It's something to keep an eye on. Now, this doesn't majorly impact my investment right now, but it's a temperature gauge into the market. You want to see how healthy is the market today. And right now it's saying, yeah, there's some good, there's some bad. It is relatively stable, but there are no real signs showing serious growth. There are no real signs showing serious decrease. So it's something to keep an eye on. That's the way I look at these things. It doesn't really warrant an entire flip, whether I want to sell or buy everything. And it's never good to panic, but it's good to be aware of what's going on. What plays into this as well, and what I find very interesting, is that, this is another side of the inflationary report. This is a EU Finance article. I find this quite interesting as well because they're very, very, very negative. And this is something that you have to be mindful of when you look at the news. It's very easy to get dragged on in the hype of a headline. They call it a dramatic slowdown, but I wouldn't call it a dramatic slowdown. It hasn't changed since April. The amount of jobs added is relatively low, but the employment rate is absolutely stable. So this is a gross over-exaggeration of the actual climate, of the actual US economic climate. So whenever you see headlines like this, don't get dragged away too much by the hype created by the news outlet. Their job is to sell you the news article, and it's less about the facts and it's less about the actual information that you can use. So tip of the day, be mindful what you read. Tariff incidents, we talked about this. Now we have shown on the consumer side what it could do to prices. Now on the seller side, you could split it up in two parts as well. There is an importer and an exporter, and historically it is shown that most of it goes to the importer, the burden of the tax incidents. And this talks about 40% of tariff increases are passed through to the consumer if you look at the historic data. So there are different price lines for each different product category, and across the whole economy, it's about 40% of tariff increases are passed through. 40% is massive, especially with the tariffs that Trump is announcing right now. There's another great article that was sent over by the doctor in economics. Thank you very, 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 very much. I won't go too much detail into this. I haven't read all of it, to be honest. But it has a nice historical outlook on what happened over the years and how many US presidents have actually implemented tariffs. So if you're interested, go have a read. To what extent do you still think these numbers are real labor numbers? There's a lot of controversy with Trump fixing the numbers. Yeah, I think you can't trust to disregard everything as fake news. I think would be wrong. To take them with a grain of salt, in my view, is the right way to look at it. Um, I can't fact check whether those numbers are right or not, but you can look at the trend, and even if the numbers are wrong, everybody looks at those numbers and interprets them in a certain way. So the fact that these numbers are published and how everybody reacts to the publication of these numbers, regardless of whether they're true or not, already tells you something about how everybody treats the economy. But my view would be take it with a grain of salt. And um, yeah, I think it's the Trump effect. He is kind of altering what we call the truth, and that's not a great thing. uh, I think what's interesting to link to this is that you see that the dollar is tanking. That is the market reaction as a whole. Not only in the stock market, but I think mostly in the bond market. People are taking an alternative to the dollar, and usually, if you want to invest in the dollar, or if you want to have a dollar backup, you buy the treasury, so you buy the U.S. debt. Um, you see a massive increase in the gold price. You see a massive increase in the silver price. Um, the gold price has gone up. I'll explain this graph later, but the gold price has gone up quite a lot, and this is mostly the reason for this is because central banks are buying gold as a backup, as a reserve currency. U.S. dollar used to be the reserve currency, or it still is the world reserve currency, but for safety, most are looking at other things to have a safe haven for the cash. And gold is historically a safe asset. And with the gold price rising, it shows that the trust in the dollar is lowering. The total value of the dollar in relation to the euro has also lost its value. So I think that's a reaction to actual market reaction to Trump altering the truth, altering these kind of numbers. And the graph you're looking at now shows the relation to gold to silver price. Now, historically, this has been about it sits around 50 to 60 for each ounce of gold. You can buy 60 ounces of silver, and it has this is a 10-year graph, and since 2021 gold has continued to shoot up in price in relation to silver, and only recently you have seen that silver has begun to catch up. The gold price has not actually decreased, but the silver price has increased. And I think silver as a material has more value than just gold. The reason why I'm interested in this as well is I own a gold and silver miner, and the gold price has shot up, and usually the silver price takes a little longer to catch up, and you see the silver price catching up. Another way this ratio could be altered is by the gold price dropping. But historically, if it's above 60, it means that silver is relatively cheap and gold is expensive, and the inverse is true as well. So one of those can still go up, and with it slowing down, it could be a good signal to sell. But we'll be looking at the business in detail later on. But this is the backdrop for that story later on. Um, any other questions? Any other things we should look at? I think I want to discuss one more thing, and that's the stable coins. A little cryptocurrency talk, but the US backed stable coins have taken a flight since Trump signed the Genius Act, which was not named after him, obviously. And this allowed, it allows stablecoin producers to produce stablecoins, and the stablecoins are backed by actual dollars. And actual dollars, they're backed by US Treasury bills, or by the T-bills for short. And what this does, it creates a good incentive for US. I think most of them are US creators of these stablecoins to buy treasury bills, and the US debt is mostly owned by China. Japan is it's owned by countries that are not the US, and even economic rivals, and that has its own risk and tail to it. It's quite clever to turn this around like this. Um, Having your own stablecoin producers that are backed by the dollar buy up your treasury bills. This gives you more control over your own debt, and it also increases the demand for these treasury bills and could therefore lower interest rates, which again is in Trump's favor. it also becomes easier for everybody to hold the dollar, and it strengthens the dollar's value as the world's reserve currency. It's very easy to transfer these currencies. The dollar could still be relatively slow, especially interbanks across countries. And these cryptocurrencies could be a lot easier to transfer, so there's some liquidity efficiency there. For the US, it generates more control over their debt, and it creates more supply, and therefore could lower interest rates in the long run. Now, there is, of course, a little bit of a risk, because how seriously are these securities backed by the dollar? How serious is the oversight and control on the dollar backing for all these securities? If this is not up to par, you're very rich, you buy all them up, and then you try to sell them all away and exchange them for dollars. And there's no liquidity on the other end, because they maybe try to get creative with it and invested all their dollars somewhere else to get a little bit more return, but therefore lose liquidity. And if they can't pay out, then the whole thing collapses and it could go to zero. So I think it's yet to be tested, but for now it's an interesting development, and it puts stress on other countries as well, because it becomes easier to hold the dollar as a reserve. The ECB, the central bank over here in Europe, could have less control over its own monetary policy, because more and more is being done in the dollar. So there's less euros around, and therefore less control for them to take hold of. Monetary policy can be quite interesting, but I think we've covered our economic session for now. I want to have a quick look at what's going on next week. There is some consumer credit report coming out on Monday, September the 8th. We'll be looking at the August producer price index. This is interesting to see as well, more inflation numbers. And that's interesting information for the Fed. I'm not really in the prediction game. I'm not really trying to predict where the Fed is going to go. But the Fed decision usually has an impact on the market, and it could be a good time to buy or to sell something. We can look at the August consumer price index. Again, another inflation report, and September preliminary university segment. I don't really care. We have Oracle numbers and Adobe numbers, and we'll be looking at Adobe later. And then we can look at it again next week and see if it has improved or not. So that's what's coming up next week.